Welcome, everyone. We will get started in a couple of minutes here. Alrighty, it looks like it's 12 o'clock on the dot. I want to welcome everyone. My name is Monisha, and I have Megan Sterling here with me today. So we are going to be presenting on strategies of credit and debit success. So we are doing a financial, financial wellness series for the next 4 weeks. So hopefully at the end of this, you'll feel a little bit more financially fit. So a little bit of background about who we are. We are with University Credit Union. We originated back in 1951 on the campus of UCLA. There were a group of staff and faculty that decided they wanted to form a credit union specific to the university community. So we serve specifically staff, students, faculty, alumni, and your families. We are a full service institution, so we have everything under the sun from checking, savings accounts to HELOCs and mortgages as well. And a little bit on the difference of credit unions and traditional banks is credit unions, we are typically not for profit and we are owned by our members. We offer lower interest rates on loans, and then we tend to offer more dividends on checking and savings account. And as I said, we serve specifically the university community, and most credit unions focus on a specific demographic or community. So before we get into our topic, I'd like to talk a little bit about our money personality. And I want you to kind of just sit and reflect a little bit. So I want you to think about the products and the services that you currently spend your money on. And as that list is coming to your mind, I want you to really sit and think about, do my current purchases align with my values? So would you consider yourself someone who's a good spender, or do you need a little bit of help? Like, what is that reflection and what is that awareness that you come to? And then when you think about that awareness, I want you to think about what are the areas of improvement that you have. And with thinking about those areas of improvement, I want you to also assess, we've got some money personalities that we're going to throw out there and we will talk a little bit about. So we've got the hoarder, who obviously likes to hoard all of the money that they have and budget really well. We've got the spender who loves to spend. We've got the planner, which I identify with. We've got the dreamer who has big visions and big goals. And in terms of a relationship, if you're sharing finances with a significant other or a family member, you might have a merger, someone who likes to put all the resources in one pot, or you have someone who's a separatist who likes to kind of keep things separate. And then we've got the risk taker and the risk avoider. And more than likely, you probably overlap on a couple of different personalities. And just keep in mind that these personalities change as you grow and you evolve. So Megan, I'm curious, what is your current personality?
Hi, everyone. Welcome. My name is Megan Sterling. I'm also a certified financial counselor here at University Credit Union. And before I share my money personality, I wanted to let you know you could all use the Q&A to put questions in there. We'll also be putting some links in there to share with you. So please utilize that feature, and we will do our best to get those questions answered for you. But my money personality, like Monisha said, is a couple of different things. I like to say I am about 70% risk avoider and 15% hoarder, but also 15% spender. I like to spend that money. You know, I work hard for it, and it's nice to have a little cash in the pocket. You know, money personality is really the foundation of everything that we're going to talk about today. And we all have different beliefs on it. A lot of us get our money personalities from how we were raised and what our families do, but they evolve over time and things change. So just because I'm the risk avoider today, tomorrow I may be the risk taker. And I always try to be the risk taker, but it's a hard one for me. But I've
Oh, yeah.
evolved, you'll evolve over time. So that was interesting, Monisha, to hear that you're the planner. So that brings us into our topic today, which is the first part is credit. And I always like to start by asking, what is credit? What comes to mind when you hear credit? And because credit is not a dirty word, it's actually a word that can really help us achieve our financial goals. But credit is really just an agreement with a financial institution to borrow some money. And obviously, when you borrow some money, you have to pay that money back. And we'll talk about how that process happens. Credit comes in a variety of different forms. Most people, when they hear the word credit, they think credit cards only. That is one form. There are thousands of different credit cards out there. Do your research when you're looking at credit cards. If you are on the younger side, you may need to have a cosigner on it. There's also a thing where you can be an authorized user on a card. A cosigner and an authorized user are two different things with it. An authorized user won't hurt your credit score as much as being a cosigner. If you're a cosigner, you're both responsible for that. If you're just starting your credit journey, you may want to get what's called a secured credit card. What that is they want to secure it with something because you have no credit history built yet. They'll put some funds in another account at that institution. And if they see that they're having a little trouble with this, they'll pull from those funds to help you out. It's a great way to start building your credit. Now, not all financial institutions have a secured credit card, but we do at University Credit Union. And finally, there's loans. There's lots of different types of loans. There's mortgages, there's auto loans, there's student loans. Loans are not a bad thing. Loans are a way that help us achieve our financial goals that we set. We talked about goals last week in our webinar, and we have those webinars recorded if you'd like to go back and watch them. I always say investing in a home and your education are two great things to take a loan out for.
Absolutely.
At University Credit Union, we have helped many members achieve their financial goals. We have helped many members achieve their financial goals through our Empower You campaign that we are running. We have saved our members last year on average about $350, which is amazing. That's a great thing that we can do for them. One of my favorite lines of credit that we offer, and it's offered at all financial institutions, is an overdraft line of credit. So what is that? So if you open a checking account and say you go out and spend and you don't quite have enough funds in there, they'll grab from this overdraft line of credit. Now, at most financial institutions, they will charge you a fee to do that. We do not do that at University Credit Union. There are no overdraft fees. There is, however, interest charged on what was taken out. But to actually use the overdraft, there's no fee for that. We also don't do a credit pull, so we don't look at your credit score to do that. It's a $500 automatic approval, and anyone can qualify for it. It's a great way to start building your credit because we want you to have that strong credit history that's out there. Like I talked about, we have the Empower You campaign here at UCU. Last year, we saved our members an average of $347. That's amazing. So when you're looking at credit, explore all the different opportunities out there. work with the certified financial counselor. We do one-on-one appointments here at UCU, and we can help you get to the goals that you are trying to achieve. And sometimes that won't involve opening credit, but it may, but we won't know until we sit down and do it. Okay, so let's switch gears, talk about how credit works. If you buy something for $1,000 and you put it on credit, and that credit card has an interest rate of 14.99%, and that APR stands for annual percentage rate, so annual yearly, you're going to pay on average $507 in interest if you just make the minimum payment of $30 a month. Now, your credit card statement will always have this information on there. It will tell you what your minimum payment is and the time it's going to take to pay it off. So be aware of that. Take a look at it. Of course, you can pay it off early if you want. Now, look what happens when you spend a little bit more. You buy something for $5,000. Your minimum payment obviously is going to go up, but look at the amount of interest. And look how long it takes to pay it off. 14 years and 5 months. So that's a long time. So how do you avoid all that interest? Pay more than the minimum when you're doing this. Okay, let's look at another example here. Let's look at if you take out a loan. Let's say you take out a loan for $20,000 to buy a car for 60 months, a 5-year loan, $20,000. And your FICO score, which is your credit score. FICO is a scoring model. It's different than your credit score. So we'll talk about that on the next couple of slides here. But say you have a really good credit score. Say you're in the 800s here, the top range. The better the credit score, the lower the interest rate that you have, which results in a lower payment and a lower interest that you're going to pay on the life of the loan that you have. Again, you pay more than the monthly, you're going to pay less interest on it. Look what happens if your credit score drops down into the 500 range. Your interest rate is almost 3 times what it was in the 800 score range. And the interest, of course, is 4 times as much as well. So the better the credit score, the lower the interest rate, lower the payment, and less interest that you're going to pay over time. Okay, let's talk about credit score. We talked about risk. The higher the number, the lower the risk. The lower the number, the higher the risk you are. FICO is the scoring model. There are other scoring models that are out there. FICO is the most widely used, but there are other ones that have been used. Does anybody know what the average credit score is? If you know that, it's around 715. I actually Googled it this morning before I came on here because I wanted to see what it was. It does change. It has gone up in the last 6 months. It was in the 600 range, but a good FICO score is anywhere between 670 and 739. So know your credit score. Now, one of my favorite things on the UCU app is that we have your credit score every day, so you can see what it is. We also give you tips and tricks on how to improve it. And so that's a nice thing to see. Your credit score is always going to go up or down a few points every week. But if you see drastic drops, investigate that and see what it is. Okay, so let's see how a credit score is determined here. One more thing before we go on to that. When you first open a credit card, you don't start at the high or at the low. You actually start right in the middle, around the 625 to 640 range. And then you work up or down depending on your behavior with the credit card. So let's talk about how a credit score is developed. There are 5 components that go into a credit score. 35% of your score is your payment history, paying on time. Now, they do give you a little grace window with it. So you do have a little grace, but try to pay on time. I always set a notification 2 days before my due dates so that I pay on time. Now, if you pay off your credit card every month, obviously you're not going to pay any interest, but they want to make sure you're paying the minimum and you're paying it on time when you do it. The next 30% is the amount owed versus available credit. We call this utilization. So if you have a limit of 10,000 on your credit card and you're at 9,000, you have a very high utilization rate. You have a 90% utilization. We're looking for 30%, around the 35% range for utilization. And so keep that in mind. When you first start building credit, you're going to get low limits that you have. As you get better with your credit, they'll increase your limit that you have. So notice that these 2 components, that is 65% of your score. So let that sink in for a moment. That's a lot. If you only do these 2, it will help improve your credit score. But to get a really good credit score, do these other 3 as well. Length of credit history. How long have you had credit and been establishing it? If you're a student joining us today, I always say, start it now. Start that journey now. You may go, I'm not making a lot of money. Maybe you have a cosigner on it. You're still going to start building your credit that you have. Because when you graduate and you get that big job, you want to be able to get those higher balances so that you can start doing things like maybe buying a car or maybe even a mortgage down the road. That's 15%. 10% types of credit used, your credit mix. So are you all credit cards? Are you credit cards and an auto loan? Do you have retail cards, gas cards? What's your mix that you're looking at? So they're looking for a mix. And then finally, new credit. How often are you opening a credit card? They're looking for 3 to 4 a year. If they see an excessive amount of credit cards being opened, that will lower your credit score. So this is really interesting. It's just fun to dive into this and see where you're at. So if you know your credit score and you're wondering where it's at, take a look at these 5 components. Okay, so there are 3 credit bureaus. When you open any type of credit, your credit is run through one of these 3: Experian, TransUnion, and Equifax. And they use different scoring models. Like I said, FICO is the one predominantly used. Your score will be similar, but not the same from each of these. When you apply for credit, you can ask them, what credit bureau are you using? And they will tell you, but they do vary. Now, if you're dying to know what your credit score is, there's a place for you to get it. You can access it at annualcreditreport.com. And it doesn't take very long to get. I always say you should do it once a year. If you're a member with us, like I said, you can see it on our app. So you don't even need to do this. And it will give you those tips and tricks. Or you can call and get a copy of it. One of the things we do at University Credit Union is we also have a team that will review your credit report with you and explain what is on that report and how to read it. It's not difficult, but there is some lingo that is used in the industry, and they will explain that and work through it with you. And finally, we want to give you some credit tips. Only use credit that you intend to pay back. Compare rates. We talked about that earlier. There are so many different offers out there. See what works best for you, what's going to help you increase that credit score. Don't use credit to live beyond your means. Last week, we talked about budgets. Make sure you have this budgeted into what you are spending. Pay on time every month. I can't say that enough. That's the first thing I always look at. And before you apply for a major loan, make sure your credit score is strong out there. And finally, protect against fraud. We always say you select credit when you're doing checkout. When you go to buy something, do credit. With your debit card, you'll get an option debit or credit. It's just safer. Next week, we are going to be talking about fraud. So we'll get more into these details. Credit cards are a good, safe product to be using. Monisha, what did I miss on credit cards that you always love to talk about?
Sorry about that. I didn't realize I was muted. So I was going to say this actually kind of segues into our next topic, but you mentioned not using credit, to get by as a means. And sometimes when I think about debt, it's just can be a really heavy word. And I want us to kind of try to take the heaviness out of debt because sometimes when we are in financial crisis and problems are happening, like it can go hand in hand. And sometimes debt feels really overwhelming. Sometimes there are people who are borrowing to get by and we fall behind on payments. So we'd like to talk a little bit about debt repayment strategies. So first step in thinking about debt is establishing an inventory. So we really want to look at how much do we owe and do we have those recent statements and really look at an awareness and become aware of what you have in front of you. And then you want to list out what's the order of importance. So maybe you have your mortgage, you've got your auto loans, taxes, credit cards, medical bills, collections, but you want to make sure you pay those the things that are your priorities first you want to try and pay those. And then once you've got all of those debts, you want to have those accounts that you're able to keep current and that don't require any immediate action. And then after you have all of that awareness, you really want to sit down and create a budget. So your budget is really going to be about your money in versus your money out. So you want to list out all of those goals that you have, those financial goals, and then list out all of your expenses. I also want to encourage you when you're thinking about your money in, you can allow yourself to be creative. And I've heard plenty of people who sat down and looked at their budget and realized that their money in that they weren't happy with. And then they've gone on to do things like starting side jobs or figuring out things to sell that they're not using, and even starting YouTube channels. So allow yourself to get creative when you're thinking about that money in as well. And then you're going to look at all of your money going out and just do a comparison for yourself. And then you want to try and look at any accounts that are delinquent. So if you have any delinquent accounts and those fall within the category of priorities, you want to try to assess those first. When you fall behind, usually the payments you miss are added to the minimum requirements. So you want to make sure you address that as well. All right. And then some of the things that we can look at as well are refinancing or loan modifications, debt management. So here at UCU, these are some of the products and the things that we can sit with you about. If you are sitting with a financial counselor, we can look at that debt and we can try to figure out what product is best suited to help provide a solution to your circumstance. Alrighty, and then you want to create that list of options, lower the costs as you need, and prioritize those debts. And then Megan, do you want to finish us up?
Sure. So, Fair Debt Collection Practice Act. This is actually a law, an act that came out. These rights are for consumers. They don't eliminate the debt, but they can make your life less stressful for you. For example, if you have a debt that goes to a collector, they are not allowed to use abusive, deceptive, unfair collection practices. Establishing procedures for debt collectors must use in contacting you. So there's a lot of good things that go out when you're dealing with debt. So you have rights when it comes to your debt and how it is managed. So you can research this and find out that. So after you've repaid your debt and you're out of that, your money personality may change and how you do things. You may be more of a planner now and a risk avoider, and this will help you in rebuilding your credit. Obviously, we know you have to have a good credit report and a score. You can improve over time by paying on time, pay down that debt, dispute errors. Errors happen on credit reports. So take a look at it. That's where the credit report review is very helpful. I know my credit score. I look at it every day. I kind of geek out on that, but I also pull my reports and I find the errors. If all your accounts were closed because of debt, you may think about a secured credit card that we talked about, or a co-signer. A lot of times debt and credit cards is because people have opened a lot, and that can be difficult to manage. So know your personality and know maybe one is all that you need. Don't use a credit repair company. You may get offers for that. Talk to your accounts first. There are ways to help. At University Credit Union, we have a skip a pay option. I always say debt starts with communication with your creditors. Establish emergency savings. Now, this is a big topic. You've probably heard this before. And savings should be at least 3 to 6 months worth of your essential living expenses. So once you do that budget, you'll know what that is. Make savings an automatic process. Okay, what does that mean? Because that sounds really like easy, but it's really hard. Pay yourself first. Do it as a direct deposit into an account. Have multiple financial institutions. Have a University Credit Union account, have maybe another one at another financial institution, and just route that money right there. I will tell you, even if it's $20 a week, $80 a month, that adds up to almost $1,000 over the course of a year. So anything extra that you can do to establish an emergency savings for what's going to happen. Now, let your money work for you. There are so many great different accounts out there and promotions. We have what we call a high yield savings. A typical savings earns 1%. I know my number's wrong here. My decimal point's in the wrong place. Earn less than 1%. Our high yield savings is paying 3.5% annual percentage yield, so on a yearly basis, but always read the fine print. For us, you have to have a minimum balance of $2,500, and it's $5 to open the account. But those dividends are dropped in there every single month. So that's a bonus there. That could be your $20 that you are putting in an emergency savings. So if you have some extra funds, maybe you got a nice tax refund, drop it into a high yield savings. Another great savings product is a certificate of deposit, a CD. All financial institutions have them. We have one at University Credit. We have multiple ones at University Credit Union. So that's another one. The high yield is a liquid account where a certificate of deposit is a frozen account for a certain amount of time. So you're not able to access the funds. I really like a high yield savings. During times of debt or financial crisis, I always say there's a couple things that you can rely on and use your resources. The first one is your loved ones. They are great help during these times of need, and they can help through transitions. Second is your community. Reach out to them. There are lots of available resources to overcome financial challenges. Food pantries, churches, state and local resources that are out there. So get online, do a little bit of searching. I know here in Los Angeles, we had the fires. There are still support for the fires. Reach out to your financial institutions. They are the first place I would always start. Again, this goes into other services that are out there. Check with your employer. They may have special things that they can do. But look into all of those. Health insurance, another one. This is a big concern for a lot of people during a time of financial crisis. And finally, have a positive attitude about this. This is a temporary situation. There is ways to help. Use your resources around you. People want to help and get you out of this troubling time that we have. Monisha touched on the budget. Again, budget's super important. What comes in, what goes out. Breaking that down a little bit farther. And we talked about this a lot last week. We like to use the 50-30-20 rule. 50 for needs. So those are your daily things, your rent or your mortgage, utilities, transportation, your minimum debt payments. What are you paying on those credit cards that are out there? Do you even know what those minimum amounts are? 30 for wants. This is all that fun stuff. And believe me, do put some in for your wants. It's okay to have a Starbucks. Maybe you can't have Starbucks 5 days a week, but maybe once a week you could have it. Or if you have a long commute, it's a nice little treat on the way home. We all work hard for our money, so wants are important. So do put some in. One of the biggest areas that go into wants are subscriptions. Do you know all your subscriptions? Do you know how many TV channels you're subscribing to or Spotify? Check those out. Reevaluate them. And one of the things I love to do with my utilities every year is go in and call them and say, hey, do you have any programs that are new? Is there something I could switch? I've been a member for a while. So everybody has tips and tricks on how to save money in these categories. And finally, there's that savings, that 20%. Now, I like to do it just as a direct deposit and not even think about it. I have one for my emergency fund. My 401k goes right through my employer. Same with my investments. And then any extra debt payments that I have. Now, you probably saw at the top minimum debt payments. That's the minimum. That's that amount that's written on the bill. This is that extra amount. Now, this slide can be overwhelming. I don't want you to get overwhelmed with it because I have a tool to help you figure this all out. And that is our budget worksheet. And I'm actually going to put that into the chat for you so that can help you. It's a wonderful tool that will keep you on track. It's very easy to use. You only fill in the gray parts. So you fill in your income, your fixed, your variable expenses, your debt, and it's actually got a tab for instructions on how to do it. So it's very easy to do. The months are at the bottom. And then once you have all the information filled in, it puts this nice little pie chart in this big white area of where everything's going. So you can see what your percentages are. Are you 50? Are you 30? Are you 20? Now, don't get really too hung up if you're not at 50, 30, 20. in California, our cost of living is a little bit higher, but it still should be close. You may be 55, that's okay. As long as you're feeling comfortable with it and you can handle that, that works. I love this tool. I always say it doesn't matter what amount of money you make, you should have a budget. Revisit your budget I like to look at mine monthly, but also do your budget when you're in a good frame of mind as well, because that helps to put it into perspective. Well, that concludes our webinar for today. Like I said, here's our QR code to schedule that financial wellness checkup. I say it's a great thing to do at least once a year. They're free. You do not need to be a member to have one. And so you just scan the QR code, or you can visit ucu.org and it says make an appointment, and we will do that. We do them virtually. And then if you're near one of our hubs at our UC Davis or UC San Diego or our UCU headquarters, you can go in and have one in person, but we do them virtual all day long. And finally, I wanted to share our contact information with you for both Monisha and myself. If you're thinking of becoming a member, that's QR code on the left, and there is the appointment. So we have about 8 minutes left. If there are any questions anyone would like to ask. Someone asked, what is the average credit score? Again, it's about 715. It's gone up in the last couple of months. Someone asked, does UCU have fees for paying off loans early? No fees for paying off loans early. That's a great thing. There are ways to get discounts on loan rates, though. If you do an automatic payment, we lower your rate by 1/4 point. So that's a nice perk to have. I put our UCU website in there as well. And this will also be recorded for anyone who was unable to join. So thank you for joining us today. And we look forward to seeing you next week about fraud.